Hello and welcome to our AASB dialogue series today on human capital reporting, evidence, insights and gaps. My name is Sabine Schürer. I'm a senior manager at the AASB. And today I will be chairing this session, which is jointly held with CPA Australia and CAANZ. And before we start, just a few general comments as usual. So the views shared in the sessions are the views of the presenters, not the views of the presenters' organizations. The session will be recorded and will be made available on the AASB website in the next few weeks. And I would also like to encourage our audience today to comment, ask questions during the session using the Q&A function, and we will aim to address any questions either during the session or at the end. With that, back to our topic. So human capital reporting, it's not a new topic, but it's still an emerging topic and not something that we deal as accountants sort of in our everyday life. So I thought it would be a good opportunity just to provide a little bit of background on this topic. So whether and how we reflect any form of human capital in financial reports or in annual statements is really very diverse, and there are a lot of questions around this issue, and there are a number of reasons for why recognizing human capital as an asset in particular, and also making disclosures about human capital is challenging. And we will hear essentially in our session today about this. So at the same time, however, stakeholders and especially investors have asked for more information about this topic. And so as a result, both the IASB, the International Accounting Standards Board, and the International Sustainability Standards Board, the ISSB, have looked into this matter. At the moment, it's predominantly the ISSB that is looking at human capital, and at the ISSB, it's classified as a research project, and the board is expected to make a decision about the future direction of this project in the first quarter 2026. So at this stage, we really do not know whether or in what form this project will go ahead. But it's also one of those projects that are listed as a common project, a project on the connectivity website by the IASB, ISSB, and that probably indicates to us that there's some overlap in between the financial reporting and the sustainability reporting side, or the non-financial reporting side. And maybe that distinction or the overlaps will become a bit clearer over time. But at this moment, it's still a very dynamic space, and probably there's much left to explore and clarify. So with that in mind, I will hand over to Eka Tan and Edwin Lim, who will be presenting the research today. Associate Professor Edwin Lim is head of the Department of Accounting at Monash University, Malaysia, and honorary associate professor of accounting at Deakin University. His research focuses on ESG and accounting information quality, with a strong record of publications and funded projects that bridge academic rigor with real-world policy relevance. Dr. Eka Tan is a lecturer at Deakin University, and his research focuses on corporate governance and sustainability, with a particular emphasis on human capital-related matters, as well as financial statement disclosures more generally. Eka is a member of the Deakin Business Value Creation Center, and many of you will already know Eka, as he has previously contributed to research projects with the AASB. All right, Eka and Edwin, the floor is yours. Thank you.
Okay, thank you, Sabine. Can you see my slides? Yeah, all right. Good afternoon, everyone. Thank you for joining us in this dialogue series. In this opportunity, we will present our research on human capital reporting, where we will try to provide some evidence, insight, and gaps when it comes to human capital reporting We would like to acknowledge AASB for the funding for this project that make this project possible. This project is also in collaborations other than me and Edwin. It's in collaborations with Dean Hanlon from RMIT University and Mehdi Ketmati from Monash University. So before we move on to the research itself, I think it will be good for us to talk a little bit about human capital definitions so that we are clear in terms of what we are trying to capture in this research. Human capital refers to people within a company's workforce and a broader value chain, which encompasses not only the headcount, but also the competencies, the capabilities and experience, and the motivations of these people who contribute to the long-term value creations. So in these definitions, it highlights that human capital is multifaceted. It's not merely just the size of the workforce, but also the attributes that drive the innovations, the productivity, as well as the sustainable outcomes. These broader definitions underpins the increasing interest in how organizations communicate the human capital risks and opportunities. Global standard setters are exploring how to incorporate human capital into the corporate reporting requirements, as what Sabine mentioned earlier. The ISSB is one of them that has a research project on human capitals, in which it starts from sometimes in early 2024 to the presentations of the full finding this year. And decisions will be made in Q1 2026. If we compare this to our project, our research is mostly Australian focused, but it intersects directly with these developments by ISSB, particularly in the emphasis on investor needs and connectivity with the financial reporting. For example, if we look at these four overarching themes that arise from our finding, these findings are highly aligned with the ISSB research project, including the emphasis that there's a strong investor demand for structured human capital informations. There's evidence that human capital issue influence an entity's prospect. There's a significant gaps and inconsistency in the current disclosure practice, and there's a limited explicit link between human capital and the financial reporting. This diagram probably will give us a little bit of help in understanding or contextualizing the issue raised in the last points, which of particular interest of today's discussions. Human capitals covers things like workforce capability, stability, well-being, and related risks and opportunity. And these factors shape the cost structures, the productivity, the cash flow, and even the financing decisions. In other words, human capital directly affect traditional financial outcomes, which makes effective human capital disclosure central to the financial reporting relevance. Our motivation stems from a clear gap between what investors say they need and what firms currently disclose. If we look at these two prior studies, we can see that there is a documented associations between human capital related matters and the stock market valuations. Investors also emphasize that human capital matters drive financial outcome, yet disclosure remain uneven, limited in depth, and difficult to compare. This gap is what underpins our two-part research design and the need for the systematic evidence. So in this project, we cover two core questions. In the first study, we look at how do Australian investors use human capital information for decision making. Particularly, we are using survey and interviews to provide us with the evidence. In the second study, which will be delivered by Edwin, how is the current human capital disclosure by Australian entities? In answering that questions, we do data extractions of ASX 200 entities. Now, looking at study one, investors' perspective of human capital disclosures, there are four key things that I would like to deliver for our presentations today. Investors clearly value human capital informations. Most respondents from the first bar charts rate it is as important to their decision making. And if you look at the second bar chart, more than 80% agree it provides critical insights into sustainability and growth. A strong majority also see that it is financially relevant, which align with the ISSB focus on human capital as a driver of future performance. Finally, if you look at the last bar chart there, most investors report they actively seek out human capital informations, although the lower level of strong agreements suggests that it is not always easy to locate. Next, we also ask participants what are the most critical human capital factors they things for their investment decision making. And these are the four human capital factors that they think most critical among all of the factors that we delivered to them. The first one is working conditions and exploitations, followed by health, safety, and well-being, sourcing practices, and pay and benefit. The percentage there reflect the proportions of the respondents, of the 100 respondents, that rate these factors as critical. This slide provides us with understandings of the gap between what investors need and what firms currently disclose. So if we look at the left chart, almost half of the respondents view current disclosure as inadequate for meeting their information need. Only a small portions, the pinkish color, minority consider that they are fully adequate. The pattern on the right also quite similar, where we ask participants if they think current disclosures adequately capture workforce-related risk and opportunity. Again, only small portions report full adequacies. And if we take these two charts together, this finding shows that while investors value human capital informations, as we presented in the first results shows, they do not believe current reporting provides depth or clarity required for their decision making. Last but not least, I would like to also present from our first study the top 4 challenges that investors identified as the difficulty in using human capital disclosure for their investment decision making. And the problems include, first one, the lack of standardizations. One of the investors mentions that even the basic things like turnover or headcounts is not reported the same way, which makes it really impossible to compare. The second point is the difficulty to find the informations. One of the investor mentions you end up reading across multiple filing just to get a coherent pictures of what is being reported. The third point is insufficient depth of information. A single turnover rate doesn't tell much about things, and the investors recommend the breakdowns by role, regions, or reasons for leaving. And last but not least, difficulty in comparing across industry, because just providing a 10% turnover rate, it doesn't really tell us anything, and we don't know whether it is good or bad. That's from first study. Over to you, Edwin.
Thank you, Eka. So over the next few slides, I'm going to share the results from our second study, which is a content analysis based on financial year 2024 annual reports by 182 ASX listed companies. So we find that 78% of the firms explicitly acknowledge human capital risk as material, but 22% don't. So this statistic suggests that materiality might be interpreted quite differently across firms, and some firms could have even underestimated the materiality when it comes to human capital issues. And if we look into the financial links, the number dropped drastically, because we find that only 18% of the firms explain how human capital risks affect the company's cash flows, and only 2% link those human capital risks to financing, such as borrowing or capital costs. And when it comes to human capital opportunities, the connection is even weaker, because we only find that 1% of the Australian firms have linked human capital opportunities to cash flows and none to financing. So the message is very clear here. Human capital is widely discussed in the annual report, but it is not yet explicitly and strongly connected to financial outcomes in the narrative discussions of annual reports. So this reinforces the finding from study 1, which Eka presented earlier. Investors find it challenging to incorporate human capital risks and opportunities into valuations, even though they recognize their growing importance, largely because of how human capital information is currently being presented and discussed in the annual report. So clearly the people finance link is still largely missing. So the next slide actually shows an example of financial connectivity for human capital information. So here, James Hardy clearly shows how a human capital or workforce-related risk, in this example, asbestos-related injury and death claims for the affected employees, can affect real financial consequences. So, for example, in this case, the required compensation will reduce James Hardy's cash flows, limit their funds available for capex and dividends, and even affect their access to equity and debt. And moving on, we also try to actually examine what are the most commonly reported human capital themes in the annual report. And the top disclosures include diversity, equity, and inclusion, employee well-being and safety, skills and development, and talent attraction and retention. So these are commonly disclosed likely because they have direct implications for operational effectiveness and reputation. And in contrast, if we look at the bottom part of the diagram, there are topics that are harder to quantify, such as corporate culture or regulatory compliance. They are less disclosed, or even if they are disclosed, mostly in the qualitative form. Next, we are actually interested in where human capital information actually appears in the annual report. So we find that human capital disclosures is quite scattered across the entire annual report. So it's everywhere. But the most common location is the remuneration report because pay, incentives, and performance metrics are inherently people related. And this is followed by financial statements and notes, which we will discuss a little bit more later, the director's report and OFR, as well as sustainability and ESG sections. And if you look into the bottom part of the diagram, only 16 companies or less than 9% actually provide a standalone human capital section. So what does this mean? It means that the human capital reporting by Australian listed firms at the moment is very fragmented. And this fragmentation make it very hard for investors and other users because they literally need to read the entire report to get a comprehensive picture of the human capital risks and opportunities faced by the company before they can relate those information to performance and financial outcomes. In the next slide, we are focusing on where human capital, what common items, related to human capital are actually reported or actually disclosed in the financial statements and notes. And the most common item is actually employee share ownership plans. And this actually reflects the widespread use of share-based compensation by most of the listed companies in Australia. And other common items include KMP remuneration, employee benefits, provisions, and operating expenses. So these common items confirm that, in fact, human capital costs and obligations are financially material. That's why they actually appear in the financial statements and also in the notes. But they are also largely compliance-focused and backward-looking, approaching more from the expense and liabilities perspective. They tell us what is being spent, but they hardly tell us why those investments are made and how they actually support the future performance and strategy of the company. So in other words, in the financial statements and notes, the numbers are there, but the strategic human capital story or narrative is presented elsewhere in the report. And the next slides give us an example in terms of how human capital information is disclosed in the financial statement notes based on Downer 2024 annual report as an example. So here under significant items, we see transformation and restructuring costs, which actually include employee benefits, redundancies, and restructuring expenses. And Downer disclose the financial connectivity here is suggest how the workforce decisions they made can translate into increased expenses and reduce profitability. Next, we also analyze which human capital metrics are mostly disclosed with quantitative data. And the top three are executive compensation and benefits, diversity and inclusion, and health and safety, followed by employee engagement and training. But when we look closer into these human capital metrics that have quantitative data, they are mostly disclosed at the fully aggregated or company-wide level. About 75% disclose the aggregated figures without any breakdown, and only 25% provide some sort of breakdown. And the majority of the companies have not provided any breakdown. This is maybe because of systems limitations that do not allow them to actually capture all the breakdowns, or they try to reduce reporting complexity, or they try to preserve some form of proprietary or sensitive information. And among firms that disaggregate the human capital metrics quantitatively, as suggested at the left-hand side diagram, the most common focus is diversity data, followed by employee composition, safety, compensation, and turnover. And the right-hand side diagram actually shows how firms break down the data, and this is mostly done by geographic location, by leadership level, by business unit, and also by gender. Now, without providing the disaggregated data, real risk can actually be hidden. because a firm may still look stable for its workforce overall or on average, but one key division might face very serious turnover issues, and this key division might be the one that is expected to generate most revenues or substantial revenues for the firm. So if we do not disclose disaggregated human capital data for key areas, this can weaken financial connectivity and making it really, really hard for investors to price risk and allocate capital accurately. So the following slide actually shows an example based on WiseTech. So WiseTech shows disaggregation of human capital in practice. Okay, so WiseTech breaks down recruitment and turnover data by gender, by age, and by region, so users can see exactly where workforce risks are actually concentrated. And the next example is based on Ramsay Healthcare Limited. And this example shows evidence for disaggregated quantitative data for human capital plus financial connectivity. So for example, Ramsay, when disclosing workforce risk, Ramsay disaggregated the metrics for staff shortages, turnover, and safety by regions. And then they discuss how these metrics affect operating performance, cost, and profitability for each region. For instance, in this example, they show that the UK has improved employee engagement, but Australia and Norway actually have worse employee engagement. Then they even attribute 140% increase in EBIT for the UK operations due to partially some human capital aspects such as lower staff turnover here. So overall, what are the recommendations we can draw from both studies Eka and I have presented after understanding the investor's need and also identifying the gaps in human capital disclosures by Australian firms? So first, we recommend to bring human capital into mainstream financial reporting because this will allow investors to easily identify the material human capital information. So when they can locate the information, they can this can allows them to easily link the human capital reason opportunities to firms' performance and future prospects, which support their valuation. And second, we also recommend to strengthen the connection between human capital and financial outcomes so that risks and opportunities are clearly linked to cash flows, even for the short term, medium term, and long term financing and future prospects, just like how we observe for the current climate risk financial disclosures. And finally, we must move beyond averages or aggregated figures because by encouraging meaningful disaggregated human capital metrics, we can give investors and lenders the clarity. This is the clarity they want to see so they can deduce where the risks and opportunities are truly sitting within the organization so that they can allocate the capital with confidence. So basically, that concludes our sharing. So I'll pass it back to you, Sabine, and we look forward to the dialogue session.
Thank you very much, Edwin and Eka, for this very interesting presentation. I'm sure the panel has a lot of food for thought on what is currently reported, what investors are looking for, and how the gaps can maybe be bridged, and also how to connect this non-financial information with the financial information. So before I hand over to the panel, please let me introduce our experts today. First, we have Michelle Harrison, who is the Director of Financial Management Advisory at the South Australian Department of Treasury and Finance, where Michelle oversees the SA government's financial management and reporting frameworks, advisory services, and whole of government sustainability reporting. Michelle is also the South Australian representative on the Heads of Treasury Accounting and Reporting Advisory Committee, that's a mouthful, HOTARAC, and chair of CPA's Reporting and Assurance Centre of Excellence. And with us today is also Lou Caporelli, head of ESG at UniSuper, where he is responsible for UniSuper's ESG investment approach. Lou has worked in equities and financial markets for over 30 years. And prior to joining UniSuper, Lou was head of research at Evans & Partners, director with BlackRock Investment Management, and partner and senior analyst at what is now Goldman Sachs. And last but not least, we are joined by Ram Subramanian, who is the external reporting lead at CPA Australia. Ram's responsibilities include formulating policy positions and commenting on reporting and audit developments, including providing input from a not-for-profit and public sector perspective. And prior to joining CPA Australia, Ram has worked in senior roles in public practice in the UK. Michelle, Lou, and Ram, thank you very much for being with us today. And Eka and Edwin have given us, as I said, a lot of food for thought on human capital reporting. So maybe we can start off with some reflections on the research. Who would like to go first? Maybe Lou, as an investor.
Yeah.
Did you want to share your perspective?
Sure. Thank you. Thank you, Sabine, and thank you for the research. One of the challenges with this human capital reporting is the it doesn't lend itself to a sort of standardized disclosure, and so we look at that sort of reporting, and it does by its nature sort of sit outside of the sort of financial reporting. I think some of the examples given in the slides were interesting from the perspective of like the James Hardie case when they had the asbestos liability. That was clearly, I mean, that had converted to a financial liability. I think one of the things that we're trying to glean as investors is to come to a view on how engaged is the workforce. And that is something that is difficult to sort of be conclusive or definitive on. And so the sorts of things that we rely on are these bits of partial information like employee engagement surveys, what's the level of turnover like, what's their ability to attract talented staff. And it really is a bit of a mosaic that you put together from discussions with companies, with competitors, suppliers, and employees or ex-employees at the organisation. And it doesn't, it's not like financial reporting. And we see this with a lot of ESG issues that we're forever seeking sort of data on this stuff. And a lot of it, especially when it comes to human capital, is rather soft. So I might leave it there and happy to elaborate, let others speak.
Thank you, Lou. I think Ram, you also wanted to share your thoughts.
Yeah, I wanted to echo Lou's comments there. I was just referring back to Eka's presentation where he talks about the top foremost critical human capital factors that investors want to see. And if you think about the four things that were there on that slide, it had working conditions and exploitation, health, safety, and well-being, sourcing practices, pay and benefits. The one that jumps out to me immediately as something that can turn easily into financial information is pay and benefits. And we do have standards and regulations around how that can be disclosed. The others, sourcing practices, maybe, especially where it can be converted into financial information, recruitment costs and things like that, perhaps could be gleaned from financial reports. But the others, working conditions, health and safety, how do you turn that into financial information? So there are challenges there. So I think there's two aspects to it. One is that an investor might be looking at how the employees, the workforce, directly contributes to the bottom line and the cash flows of the business. So that's one aspect to it. And then the other aspect is how the entity is behaving in a socially responsible manner. And that, of course, contributes to investor decisions as well, but not in the same way as it does with its the employees having an impact on cash flow. So a slightly different aspect to it. So maybe there's something there to think about how those two aspects or two elements can be considered in a holistic way. Thanks.
Thank you, Ram. And I think some of what you just mentioned really also reflect where we do have financial reporting standards for, and then the other aspect of, those maybe non-financial information that might be needed to supplement the picture, I guess. Yeah. So, Michelle, you wanted to provide some perspective too, yeah?
Thanks, Sabine. I thought what really struck me with this research at a more fundamental level is the consistency with which the research is demonstrating the investor interest in having these human capital disclosures. So I found that quite surprising, just in terms of how consistent it was that investors were identifying that they do want this information. And from that, the sort of disconnect between the investors' stated desires and what is being provided, and the frequency with which information is being provided by companies which suits those needs. I also found it really interesting what the investors are considering that they are gaining from the information which is provided by these disclosures. And I think that provides a really interesting challenge to us in understanding what is helpful to bring into a standardised format through disclosures and what needs to be more bespoke. And also what we can, as preparers, confidently articulate that these sorts of inputs, these sorts of metrics mean this, and how can we confidently explain that? It's an interesting area to apply these concepts to.
Yes, thank you, Michelle. And I think, Lou, picking up on what Michelle just said, what are some of the information that you as an investor actually look for? And then how does that affect your decision making?
Well, I mean, there's a few sort of domains when we look at this human capital disclosures. So obviously, health and safety is an important are important considerations for us, because we take a view that if companies aren't managing health and safety issues well, then they're likely to be managing other areas of the business poorly as well. And so that to us is almost a litmus test of management competency, that we look at that. Now, you can't help unfortunate situations, and you have to be sort of fit for purpose in your approach. So obviously, if you're in financial services, the risk of physical injury isn't as high, but there can be a lot of sort of mental health type issues, and workplace bullying, doesn't matter what the enterprise is like. And disclosures on that are certainly not mandatory, and the impact on the financials is difficult to make a sort of direct link to. But I guess it would be our observation that companies that are having challenges with their workforce, across those sorts of issues, which would be manifested in things like high turnover or a deteriorating safety track record, are a bit of a red flag for us. So it is very difficult with this sort of soft data to be particularly definitive on how you sort of factor it into an investment decision. And like I said, a lot of it is essentially putting together a mosaic and building a picture that way, rather than being able to draw more definitive conclusions on individual pieces of data. But things like an employee engagement survey are useful for us to look at, and it isn't just the point in time that we're looking at. We like to observe it over a trend. And the difficulty with that is that time series inevitably get corrupted, because the way things have been done 2 or 3 years ago may change. And so there's data comparability issue across the time series and that sort of thing. But we do look at that data as a sort of to get an initial view. But then what we like to do is engage with our companies, and it becomes a prompt for us to ask management in our engagements on, what's the story underpinning that data.
Right. So you're actually going directly to the company rather than relying on publicly available information.
Well, I don't want to overstate that. I mean, we would have tens of thousands of securities, but obviously for our largest Australian investments, we absolutely have those sorts of engagements. Like only this week, we had a significant engagement with the safety representative at one of our companies where there has been a bit of a deterioration in safety performance, and that's the sort of thing that my team does as a routine thing. But obviously, it is sort of case by case, situation dependent. If a company's got a deteriorating safety track record, then that's something we're going to hone in on.
Well, that's very interesting. If I may play devil's advocate here, so would a company who has maybe a poor track record be better off not disclosing such things?
That is a very, very good question, and particularly in the early days of a company starting to disclose ESG data, we encourage them to treat their ESG reporting across all domains, not just human capital or safety or whatever it may be. We encourage them to treat that reporting as a safe space, by which we mean if a company is new to introducing a more rigorous safety practice, it is completely within our expectations that the safety stats will start alarmingly high, but what we're wanting to observe is an improving trend over time. So we do encourage them to make it a safe space and not be discouraged or wanting not to disclose that sort of data. But it is a concern from some companies, but and most companies, I mean, it's worth making the point. Most companies do want to do the right thing, right? And particularly where they are introducing safety metrics into their remuneration, then that sort of data has to be published, because we need, as investors, to make sure that management, that the board isn't being soft on management and just paying them big bonuses for not achieving their, stated, performance metrics or KPIs.
Very interesting, Lou. Thank you. Is there anyone who would like to comment on what we've just discussed? And if not, then we will move on to a public sector perspective. Michelle. So in Australia, the public sector provides quite a range of what we would probably be able to label human capital disclosures. Could you maybe run us through some of the disclosures that are currently provided?
Absolutely, Sabine. There is a very a wealth of information provided by Australian governments about human capital matters. And as there should be, if we look at the context of public service within Australia, we're looking at over 2.5 million people, according to the Bureau of Statistics, worked for one of the three levels of government at 30 June this year. But we have in each state and territory government and in the Commonwealth government, there's a commissioner for the public service or an equivalent. And these commissioners are independent officers, and they have responsibility for the oversight of the public service and support the public service in being capable, serving with integrity and focusing on the public interest. So these commissioners produce reports each year. They're ordinarily required to do this under law. And these reports provide annual information about the public service, and they're often called the State of the Sector reports. And they provide information and metrics about the public service as a whole. And they're sort of metrics that it would include definitely the number of employees, the average salary, gender split, age distribution, how many employees are Aboriginal or Torres Strait Islanders, the levels of cultural and linguistic diversity within the public service, how many employees have a disability, how many were recruited and separated, and the average length of service. And more recently, we're seeing statistics coming in some governments about neurodiversity and the proportion of the service with neurodiversity matters. So there's also information about disciplinary matters, rates of completion of performance reviews, and work health and safety. And workplace flexibility we can see included as well. So there are some differences in what each government will report, but overall there is a high degree of continuity in the information in these reports around the country. Speaking of surveys, and Lou mentioned surveys earlier, these commissioners will each conduct a survey of the public service every year or 2 years, and that is providing us with some longitudinal data. And from that, that's giving really great indication of wellbeing and engagement, as well as a range of other topics. The other thing which you'll see with the governments more generally is that there is that information about policy strategies, so that more forward-looking information rather than point in time. So if, for example, if you were to Google right now, how is this government improving work health and safety? You'll find information about its policies and strategies to improve the health and safety of government employees, as well as, more generally in the public through a regulatory role. So at an entity level, we do have similar sort of information in the state of sector reports is included by agencies in their annual reports. So, and you can see some more detailed information about remuneration of higher paid employees and some more detailed breakdown in particular of work health and safety matters. And then we've also got the information in financial statements as prompted by the accounting standards. So there is a wealth of information provided by government about human capital matters.
Thank you, Michelle. So if I look at the type of information that's provided for the public sector, the first question that comes to mind is there any of this information that would be useful to shareholders in a private sector environment? And if so, why is it not provided, or why is it provided in the public sector but not in the private sector?
Sure. Well, I did notice a degree of correlation between the disclosures I've just been talking about and what Edwin presented in the research there. So certainly there is a degree of crossover there. When you say investors, Sabine, we do have to think about investors in a couple of ways in government accounting. So we have the traditional concept of investor. So we do have people who buy government bonds, and they have interest, such as Lou's organisation, will have interest in a range of information about the government in understanding whether they want to purchase these bonds. But we also need to think about the idea of investors in a broader sense in terms of Parliament and the public. And the framework for the presentation and preparation of financial statements instructs us on how to think about that. And it's explicit that we need to think about those investors and lenders in that broad sense and think about that in terms of their needs, in terms of what's happening in government. So with the degree of information that is provided by governments, it's, surely driven by that broader accountability concept. Parliament and the public do have a strong interest in the public service, the numbers of the public service, the cost of the public service, but also how the public service is conducting itself. So I think there is definitely that sort of broader concept of investor is driving the degree of information that is shared by governments. In terms of how it translates to the private sector and why they don't provide that same degree of information, the interest groups are narrower. And yes, it'll be interesting to see how that changes over time, though, with the sustainability reporting concepts that we're seeing being as more of a requirement of investors. We'll see how that translates into the future.
Yeah. Ram or Lou, would you like to comment?
No, I think Lou and Michelle have pretty much hit the nail on the head in terms of what investors want as disclosures across a range of things. I suppose my contribution is probably looking at it from a financial reporting perspective, perhaps. So if I think about it in the context of accounting standards, how do they cater to financial reporting of human capital? And even if you look at the term human capital, the word capital tends to draw you towards the balance sheet. But the information that you get through accounting standards is primarily focused on the profit and loss account. So employee benefits and remuneration payments and other things which are more likely to be seen in the profit and loss statement. So what do you see in the balance sheet that is related to employees? And that probably brings into the question, how do you consider your workforce? Do you consider them an asset? I suppose every business would consider your workforce as an asset. But it probably doesn't meet the definition of an asset in the strictest accounting sense. And that's probably where the challenge is. I mean, there are a couple of exceptions to the rule, if you wish. I'm aware that in Europe, for example, there are soccer players, football players, as they are called over there, whose contracts are actually capitalized by the clubs because, firstly, they're of extraordinary value. They run into hundreds of millions of dollars. So these clubs pay a lot of money for these players to play with them for a particular period of time. And the contracts themselves are worth a lot. And of course, the rationale behind it is not necessarily just about the individual who's coming across, but the value that they bring in terms of revenue. So they're talking about advertising revenue, sponsorship revenue, TV revenue, and other things that player brings with them. So that brand recognition, if you wish. So there is a practice of capitalizing or putting on the balance sheet contracts that are used to bring players, soccer players, into a club, and they stay with them for a few years. That's the only example I can think of. I mean, there was paper presented at this year's AASB research forum on non-compete clauses, which looked at, the possibility of non-compete clauses being considered as intangibles as well. But once again, there's the challenge, how can you consider this to be an asset for accounting purposes? And that's where it really starts to fall down a bit. And so I think whilst human capital would probably be best placed under the intangibles category, whether it constitutes an intangible asset is probably where the challenge is. And that's probably why most of the information gravitates towards the profit loss in the pure financial reporting context. And of course, Michelle and Lou have talked extensively about the information that is held outside of the financial statements, which is of high value, no doubt, but not what you would get within financial statements. That's probably where I'd add my 2 pence worth.
I might just add, like, Ram has chosen a sort of classic case of human capital getting a dollar value put on it, but even then, it's not. I mean, it may be a balance sheet item, but it's really nothing more than a deferred expense, right? And on that basis, it is what it is, and it's almost like it's a historical cost accounting exercise. As an investor, what we're focused on is what is it's that sort of age-old question about recognizing internally generated goodwill, because that's ultimately what we're talking about with the human capital of a firm. I mean, a service-based organization, its fatal flaw is that the assets, such as they are, they're typically not recognized on the balance sheet, go up and down the elevator every day, right? And they leave the building. Although these days, in a more virtual world, that doesn't even happen anymore. But it is something where there's serious risk of overreach from the accounting community if we're trying to sort of quantify or put a value on, like, good luck to the audit firm that's then required to audit someone's estimate of what that human capital is worth, right? And so inevitably what happens is it only gets recognized on an acquisition, and then, whatever the premium is, the accountants and the auditors go through this exercise of valuing all the hard assets, and the balancing item is recognized as some sort of intangible customer contract or whatever label you want to give it. And then it's just subject to an annual impairment. But we do need to be mindful of overreach with this stuff. Like, I work in the ESG space, but I'm still staying very close to the financial reporting space. And I'm not arguing for a sort of distinct separation or a siloing, but I just think there needs to be the broad recognition that, the sort of things that ESG analysts will look at do have a bearing on what the financial analysts look at. It's just that the timing effect could be delayed. with that.
Sorry, Ed, can I just add a couple of things to what Lewis just said? I wholeheartedly agree with what Lewis said. Financial accounting does have boundaries, and we must recognize those boundaries. And this is where I get onto my connectivity high horse. And that's probably where we need to think about, things like integrated thinking and integrated reporting and connections between all these different types of information. And I go back to Edward's presentation where he referred to only 1% where linking of human capital opportunities to cash flows happens. And maybe that's where we need to think about it a little bit more outside the box, if you wish. How do you actually connect all this information together and make it speak in a holistic way? So that's probably where the challenge is.
Yes, very interesting discussion. It really sort of brings forward the some of the maybe discussions that might still need to happen with regard to the term human capital, right? Where it draws us to the balance sheet, and then also when we talk about human capital, what do we actually talk about? Does it include things like that internally generated goodwill, or is that different from when we look at it from an ESG perspective, etc.? So it will be very interesting to see how developments go in this space. It also reminded me of a question that I had still in the public sector. So what are some of the challenges where maybe in the financial reporting space, does the public sector or the not-for-profit sector have any additional challenges in the human capital space? I guess financial reporting, ESG reporting.
Yep. Happy to talk to that, Sven. So, we do have accounting standard requirements based on IFRS, but with adaptation for not-for-profit and sometimes explicitly for the public sector as well. We have similar disclosures to what's prompted by IFRS and some different standards. So, for example, there are disaggregated disclosures required about major categories of income and expense, and that's similar to sector reporting. And the sort of value that we can get from that is by breaking down the employee effort applied towards certain areas of government activity. We also have some requirements in the income standard, AASB 1058, in respect to volunteer services. So this requires that if you have received volunteer services and you can measure them reliably, and you would have purchased services if those volunteer services had not been made available to you, then you're required to record them as income if you're a certain type of government entities. So there are a number of government entities where volunteer services are absolutely critical. And whether or not they're captured by that requirement, there is also the option under that standard to report the income from volunteer services, even if you're not strictly captured and even if you wouldn't have otherwise bought them. An example of some of the entities where volunteer services are absolutely critical are firefighting services, particularly for regional areas. So here in South Australia, the Country Fire Service, but you've got the Rural Fire Service in New South Wales and others all around the country. And those entities are utterly dependent on volunteer activity to support those firefighting services. But I looked at New South Wales, Victoria and South Australia as well. None of those income statements are reporting income from volunteer services. The New South Wales statements explains that if there's fluctuation in those volunteer numbers, they don't purchase additional services, and therefore you have to draw the conclusion that that's some basis. But there's also challenges in the measurement of volunteer services. So even though the accounting standards do prompt that information and are effectively saying, look, if those volunteer services should be recognised in those circumstances, even those entities where it's really important, it isn't done. Having said that, in the annual reports, there are extensive disclosures for each of those entities and all around the country about the volunteers which provide those sorts of firefighting services, about the quantity of services they have provided, but information about the volunteers themselves and who they are, what age groups they are. So there is a lot of information provided about those volunteers, but it hasn't been done through the financial statements directly. I also would just point out that with the distinction between what's provided in financial statements and what should be provided elsewhere, there is the implication that if it's within the financial statements, it's going to be audited. So I think as we, consider these matters, to what degree do they need to be audited? And, is there that investor demand that they are audited? Because if they're in the annual report, sure, they will be contemplated by the auditor as part of their audit, but there's not going to be that attestation about the information there.
Yeah, some very interesting points, Michelle, especially about auditing and insurance. And we know that, with non-financial information that provides different challenges again. So just a reminder also to the audience, if you do have any questions, please add them to our chat. I think reflecting on the discussion so far, and I might include also, as usual, the researchers, Eka and Edwin as well, if you would like to comment, but reflecting on the discussions that we had on the research provided. So what do you think should be some of the main perspectives or focus areas where the standard setters could maybe focus on with regard to human disclosure, human capital disclosures? Yeah, Edwin.
Thanks, Sabine. I believe because based on our conversations with the retail and also institutional investors, they really generally support minimum rather than full standardization of human capital reporting. And at the same time, they also recognize that materiality and key themes for human capital can vary across firms and also industries, but they appreciate a baseline level of consistency that will actually improve the accessibility and comparability of the information without constraining from specific narratives. So at the minimum, we believe that maybe partial standardization could actually guide where human capital information is located in the report, so investors can easily find it, and it could also specify core topic for disclosure. Right, for example, modern slavery, employee safety, and workforce turnover. And on top of that, firms are actually free to add whatever that are more material for their organizations or industry. And I think a minimum framework will also offer clear guidance and in terms of how firms structure their human capital reporting, because at the moment it is actually absent, and companies actually referring to multiple frameworks when it comes to human capital reporting. That makes things really difficult to compare. And I think firms should also be guided, with examples in terms of how they can actually link the metrics to cash flow and financing decisions, how they govern those risks. I think that is also very important, and whether to provide disaggregated data, and even when they provide the data, whether they should provide time series data for comparisons, and even whether they just limited themselves to historical data, or they can also provide some forward-looking estimates, and what are the assumptions that are involved when they provide those estimates. And on top of that, of course, they should be given the flexibility for more context-specific disclosures.
Thank you, Edwin. Anyone else who would like to provide some suggestions for the standard setter?
I actually think what Edwin's proposing makes a lot of sense, because I'm not a believer in standardized reporting for some of this sort of softer data, and I would never want preparers to choose their own adventure on how to do their financial reporting, and there's a need for quite rigorous and prescriptive standards like we have for financial reporting. But I do think for this sort of non-financial but still important reporting, a non-standardized approach is appropriate. But part of what that could look like is more a set of principles around what guides companies to choose the disclosures that they do, and that they be required to justify why they're choosing particular metrics for reporting, rather than then just putting together what's convenient.
Yeah, that makes that will give the standard setter something to think about. Also, another question that we had was, relating back to that connectivity piece. How can we really ensure that human capital disclosures are really meaningfully connected to financial statements rather than being siloed in either, in financial statements or the other parts of annual statements or even outside. What do you see a way forward in that space? Maybe Ram.
Yeah, I mean, the IASB, the IFRS Foundation, I should say, already has connectivity on its radar. So it's looking at the connectivity between financial and non-financial reporting as a potential issue to consider going forward. The IFRS Foundation also has the integrated reporting framework now, which arguably does have that broad overview of all the 6 capitals, which includes human capital and financial capital, amongst other capitals. And they're supposed to all be presented in an integrated fashion. So I think there is some scope there. And CIPA Australia has been a long-standing supporter of integrated reporting. And we produce our annual report as an integrated report. And we have done so for many years now. So for us, I think there is merit there to consider integrated reporting as a potential way forward to consider how those different capitals work together in providing value to investors and others.
Man, if I could just offer a public sector perspective here, I think where our experience is that it's quite normal to have different areas of government report on different matters, and for that to be contained in different documents. Perhaps we've got some advantage in that the information which is provided is often provided to Parliament. So there's that central repository of information with tabled parliamentary papers, but also it's very easily accessible on government websites as to where you can find that information. So I think this is a question which we're going to have to think about through a sustainability concept generally, as well as being relevant to human capital disclosures, in terms of what needs to be brought together under the one disclosure, what needs to be in the one document, and what can be happily separated out and reported by different responsible areas of government.
Yeah, thank you very much, Michelle. It is certainly always helpful when we can find information in one place easily. I think that is also very similar to maybe at the moment, the sustainability information in government, right, which is across many places, and with human capital also being non-financial information to a large degree, then obviously these are similar issues. Now, we did have a audience question about how we can view the opportunities. I might rephrase the question a little bit, but how we can see opportunities coming out of human capital disclosures. Like there was a lot of discussion about the risks and human capital as a risk management initiative or perspective. But what might be some of the opportunities that might arise from such disclosures? And I think, Lou, you've mentioned that really it's seen as something that is expected, or there's a red flag when things do not go well. But it might be a bit difficult for some companies to actually see those benefits. Do you have any further thoughts on how companies might be more convinced of the benefits of such disclosures, and funders as well?
One thing I would say is memories are dimming now, but we had the Royal Commission into the banks and AMP a few years back, and there was an obvious sort of financial consequence of poor sales-driven cultures leading to bad outcomes for customers. But then when the regulators found out, the companies were fined. More recently, we've had ANZ, be hit with a $240 million fine from ASIC for various regulatory and compliance failures. And that started to have investors question what is the culture like at that bank. And so, the avoiding of, serious fines for poor management of workforces is an obvious way of demonstrating the value behind it. But in my experience, this isn't necessarily an area where companies don't want to disclose. Like, one of the more embarrassing things that regulated entities have to do is talk about, the number of employees who have been disciplined or compliance breaches and that sort of thing. And, we as investors don't need to know names, addresses, and serial numbers of every incident that occurs, but some disclosure around what are the regulatory breaches that have occurred, how serious are they, and what is the consequence management to undertaken at an organisation and even up to a board level for those things, are the sorts of things I think are useful. I mean, I'm conscious that I'm just picking on examples of bad behaviour. There should also be opportunities for talking about cases of good behaviour, but inevitably it starts to become a collection of anecdotes rather than comprehensive reporting.
Yeah, thank you, Lou. And I think Edwin and Eka, you also mentioned in your research that there was a very low level of reporting of the opportunities, right, in human capital, and sort of really the positives of this aspect. So maybe there is some room to develop.
Yeah, Sabine, I think the disclosures on human capital disclosure opportunities, I think is because firms mostly approach them from a compliance and risk avoidance perspective. So they haven't actually thought of the positive side of it. And in fact, there are examples that companies can do to emphasize on the opportunities in these aspects. So for example, in the era of AI, so people are scared that they are, losing their job. So what can companies do and spend and invest, in upskilling these employees? So, going through all sorts of training, and at the same time, this can actually open the opportunities for the companies to enhance the productivity and efficiency. And in fact, there's also a potential that can actually maximize the returns in the long run. So perhaps to a certain extent, they can also start to quantify how such investments can actually lead to stronger performance, using a few years of the dollar spending data. So that's we view about human capital opportunities disclosures in the firm.
Thank you, Edwin. I think that's some very good points, because I might be speaking for myself only, but I think as accountants, we are trying to look more for the risks, right, and be very conservative. I don't know whether you agree, but yeah, maybe it's we need to be starting to think a bit more creatively and really also focus on the benefits. I'm a bit conscious of time now, so I might just come to my last questions and go around the screen. So future outlook, how do you see human capital disclosures or even recognition evolving in the next sort of 3 to 5 years, particular, in the context of ESG, but also financial reporting? And what are some of the unresolved questions maybe that you see in this space that the standard setters might want to consider or focus on? Who would like to go first?
Oh, I'm happy to, Sabine. Well, certainly, this topic has got the interest of standard setters in contemplating this issue, and with further research, we're getting a clearer picture as to what investor needs are. So, I think for me the conceptual issues about what is useful to include in sustainability reports. What are we going to see coming out if we see more application of S1 as well as S2 over time? And from my perspective, I'm particularly interested in understanding how standard setters and others are going to see the role of various sorts of reports and what should be in each.
Thank you, Michelle. Who would like to go next?
I can make a comment, but it's not so much about reporting itself. It's more about the impact of technology on human capital, particularly artificial intelligence. And that's probably something that has long-term impacts for how organizations see human capital. We're doing some studies on this, and our most recent small business survey, business technology survey, found that people are still uncertain whether their hiring practices will change as a result of the use of artificial intelligence. But it's definitely something to keep in mind. So I'm not talking about disclosure here at all, but more about organizational behavior as artificial intelligence takes hold over the coming years.
Thank you, Ram. Certainly a very important disruptor or a challenger, for the human workforce. Lou, thank you.
Yeah. I guess I go back to my theme about having some sort of framework for reporting on human capital that is sort of fit for purpose, entity specific, but decision useful, right? So, like the best sort of standard or principle is, the sort of Warren Buffett thing that, if I was an investor in your company, what would be the sort of information that I would want the management to disclose to me that will help me make a decision? So obviously the companies that have all these sort of financial reporting obligations, but there would be a raft of internal sort of management metrics that are held within the organization, and it's a matter of how widely you want to share those in public reporting. But there should be an opportunity there to talk about, obviously to highlight areas of concern, but also areas of opportunity and stuff. And it is awfully hard to be too prescriptive about that. But sort of improving trends in, turnover would be helpful, particularly in a situation where companies have experienced high turnover. And we've had that situation with some of the companies we've had where post-COVID, companies experienced a spike in turnover because people were reassessing their lives and leaving jobs. And what happened was that they'd had a flow-on effect into safety, because what was happening is they were recruiting new people. They didn't have the experience of all the people who had left, and inevitably there were more safety incidents until the workforce got trained up. Now, they're interesting sort of stories to hear about. You can get that through the numbers, but a good management team will go to some effort to explain what's sitting behind the numbers, either if something is overly alarming or looking, exceedingly good. And inevitably, there's a story behind it that may mean that the initial interpretation of the numbers isn't necessarily as good or as bad as what you may think.
Yeah, so Lou, if I hear that correctly, so you're really wanting to see more non-financial information rather than necessarily financial information. Is that correct?
Yeah, I wouldn't necessarily frame it in such a binary way. I think we're well served with the financial information that we get. I mean, you speak to any investor, I'm sure there's more and more financial information that they would want. But there is non-financial information that, while being non-financial, is not relevant, is still relevant to the financial performance of a company. But the trouble is, well, not the trouble, I guess the mindset is that the non-financial information today may not inform today's financial results, but it might inform future financial results.
Yeah, which is where the connectivity comes in again, right?
Yeah.
Yeah. And Edwin and Eka, you go first. Yeah.
I think it's important to highlight one key points that we also find from the research that we expect that in going forward there will be more disclosure that aligns with what investors really want and need in their decision making, as what Lou mentions earlier. And there should be a guideline, as what Edwin mentions earlier, from the accounting bodies to guide the disclosure so that it is not too boilerplate, because when it comes to like the same disclosures for every companies, then it's not going to be useful, even though there's a disclosure there. And touching on what Ram mentions earlier, I think it's really interesting because in some of the interviews, some interviewees mentions about AI as well, but rather than see it as problems for human capital, some interviewees indicated that it could also help in the developments of the reporting itself. Yeah.
Thank you, Eka. And Edwin.
I guess we can leverage the disclosure architecture of IFRS as one, as many investors, I think, in the future years will already be very familiar with the structure, the terminology, and also the logic. So if companies can discuss how, physical risk and transition risk, for example, in the climate context, right, affect the cash flows over the short-term, medium, and long-term period, I believe to a certain extent we can also apply the logic when it comes to the human capital. It's just that we need some modification there. And aligning human capital disclosures with this architecture, I believe, will actually enhance the comparability, the usability, and also the investors' confidence. And I believe it also reduces the learning cost for the users while preserving the flexibility for firm-specific materiality.
Thank you very much, Edwin, and thank you all to all the panel. This is all we have time for today. I think we've really touched on many aspects of human capital, from the terminology to the recognition to disclosures, what investors are looking for, what the wider public might be looking for in the public sector. So I'm sure there's a lot of room to think about it more, and for any kind of principles to start to develop. And as I said at the start, this is really in a research phase. There's nothing definite. We don't even know whether there will be a project by the IFRS or not. But definitely we've heard there is some demand, and there's much to explore yet. So thank you very much for today, the panel, Michelle, Lou and Ram, and of course the researchers, Edwin and Eka. Thank you to the audience for joining us today, the last dialogue series for 2025. I wish everybody a very happy festive season and a good start into the new year. And we will see you in 2026. Thank you very much.
Thank you.
Bye.